Let's hear from Kathy Feck on real estate. The bottom line: investing in real estate is smart because property is tangible. People always have, and always will, need shelter. This means it is very unlikely that our need for shelter will ever go away. Loans are what investors use to grease the wheels of their potential investments. Without loans and lenders, leverage in real estate wouldn't be possible. Getting a loan allows an investor to pay just a fraction of the cost, allowing vital resources to remain in place for upkeep and repairs of a property. The better the loan you have, the better your investment will ultimately be. Having that said, let's take a look at what it means to deal in loans and their respective lenders. Most common loans investors receive. There are a variety of loans that investors might receive in their quest to acquire real estate. Each loan has its strengths and weaknesses. The value of a loan package should be weighed in consideration of the underlying factors of a property. If it's a real fixer-upper, for example, you might want to borrow enough to allow for the extra expenses that will be incurred. The most important thing to consider, however, is the interest rate that a loan comes packaged with. Different loans, of course, come with different rates. Here are a few examples. Fixed rate. Having a fixed rate ensures that the interest rate on a loan remains the same for a long duration of time. Such a loan is ideal for those who wish to buy and hold a property for an extended period of time. Adjustable rate. An adjustable rate is not fixed in place and can be adjusted while the borrower is still in the process of paying back the loan. Government assisted. If you are eligible to make use of a government-assisted loan, it could be a great boon to your investment. The government-backed FHA loan, for example, allows an investor to acquire property and then turn them into rentals after they have been lived in for at least a year. The great thing about FHA loans is the fact that they typically ask for the bare minimum when it comes to down payments, sometimes at a rate of only 3%. This is good if you are struggling to come up with enough cash up front. Purchase money loan. Out of all the types of loans that an investor might work with, the purchase money loan is probably the most unusual. These loans occur when a seller has agreed to finance the purchase of their own property. At first glance, such a notion sounds a little bizarre, but under certain conditions it makes sense. In this situation, the investor is given what is termed as an investment loan and is then expected to pay it back with high investment property mortgage rates attached. The property owner ends up getting a profit over time through interest, and the investor gets to acquire the property without putting out too much money up front. It's certainly not for everyone, but if the conditions merit it, this option is on the table. Some reputable lenders to consider. After considering the types of loans available, it's time to consider the type of lender from which to get those loans. When it comes picking a lending institution, it's a long-term commitment, so choose wisely. Loans are supposed to help us, not hurt us. The wise investor only enters into agreements with lenders who can help them obtain the best possible return of their investment. Having that said, here is a list of some lenders that currently rank among the most reputable. Quicken Loans. Quicken Loans has a lot of good utility to it, and they are tremendously dependable since this lender works out of every state. The rates offered by Quicken Loans are generally good with both fixed and adjustable rates available. Down payments are usually fairly low, in some instances as low as 3%. Northpoint Bank. Northpoint Bank is a good option for investors because they have a wide variety of loans to choose from. Northpoint even offers some loans with a no down payment option and with short-term repayment plans. Like Quicken Loans, Northpoint Bank is also available nationwide. Lending One. This lender is great for those wishing to fix and flip properties. Their pre-approval process is streamlined for quick access, and once approved, as much as 80% of loan-to-cost can be financed. Lending One is also highly praised for its low rates, which provide the investor with maximum leverage. The only downside is Lending One's down payments, which can average as high as 15%. Citibank. Citibank comes with a plethora of options and even provides investors with customizable mortgage rates that can be computed right on their web page. Both rates and down payments tend to be on the lower end of the spectrum, but applicants will have to pay a mortgage application fee. Making use of home equity. The equity of a property is the total value of your property minus what you owe on it. If, for example, your property is worth $300,000 and you still owe $200,000 after crunching the numbers, you therefore would have an equity worth $100,000. This enables you to take out a line of credit worth the equity already established by your property. If you are in need of quick influx of cash for repairs and upgrades, that extra $100,000 could really prove pivotal. Just keep in mind that the interest rates of home equity loans tend to be higher than others. Because a home equity loan is essentially a loan attached to another loan, it is dependent on the status of the original and comes with interest rates higher than the rate that came with the initial mortgage. There are many sad stories of folks using home equity to do major overhauls of their home and ending up in over their head. They use their line of home equity as their own personal credit card to fix up their house with the intention of selling it later. Yet these novices make a few missteps and their upgrades end up doing more damage than good. Such a nightmare scenario leaves one severely in debt with absolutely nothing to show for it. Home equity isn't for everyone, but for those seeking an alternative solution, it can sometimes make for a good plan B. As we have repeatedly stressed, it's important to weigh all of your options before diving into a major investment project. In the end, it's up to you to decide if taking out a little equity could be of benefit in your real estate investments. This and everything else mentioned in this chapter are just a few additional things to consider when you are dealing with loans and lenders.